Morning everyone, welcome to Ainsley News. It's the end of the week. Everyone made it to Friday. It's the 11th of Feb. For those out there celebrating Valentine's Day, have a great time. And even if you're by yourself, have a great time as well. Today we're talking US CPI. You might have seen some amazing numbers coming in from the US within the last 6 hours. 7.5% inflation. Wow. The US CPI print came in last night and again exceeded expectations at a blisteringly hot 7.5%, the highest seen since March of 1982, when rates were 11.5% and not zero. This was the ninth beat of transitory expectations in the last 11 months, but it was the market, a Fed member reaction, and most importantly, history that should have holders of financial assets worried. Got a few charts in there today, so jump over to ainsleyBullion.com.au and check out the news section. And you can look closer at these. But these charts that we show you tell a very clear story. 20 straight months of CPI increases across both goods and services. And core CPI hit 6%. A few more charts illustrating the tenaciousness of the transitory narrative. Firstly, the price rises at the factory door are still way outpacing CPI. As we've discussed before, that either means businesses' earnings drop as margins disappear if they don't raise prices, or they raise prices to match PPI and CPI rips higher. Both are disastrous for shares. Secondly, wage growth is not keeping up with CPI. So either wages go up and more pressure on prices through consumer spending, or wages go up and more pressure on earnings, or wages continue to be outpaced by pricing rises, as has happened for the last 10 straight months, and the socio-economic and political issues we've seen exacerbated by the rich enjoying rising asset prices while the rest go backwards, flare up. We then had St. Louis Fed President Tim Bullard last night light a fire in markets calling for a full 100 BPS or 1% rate rise by July the 1st, starting with a double 50 BPS hike immediately. That hasn't happened since the year 2000. By immediate, he's literally taking a special Fed meeting right now, not waiting for March. That sent the market pricing a 50 BPS rise from 60% after the print to 100%. As you might well imagine, Wall Street sold off, with both the S&P 500 and NASDAQ down around 2%. This easy money-addicted share market is staring down the barrel of tighter policy, and it definitely doesn't like it. The market of truth, the US bond market, is also very, very telling right now. 10-year bond yields spiked above 2% for the first time since 2019, and yield curves collapsed across the board. The 2-year 10-year plummeting to its lowest since the grip of the COVID recession, and the 5-year 30-year to the same level that saw the Fed reverse their tightening attempt in 2018. Forward swaps are already beginning to price in rate cuts amid a recession in 2 years. And whilst talking of too little, too late, hiking into weakness policy error, let's just pause and consider that at the time of a 7.5% inflation print, the Fed is still printing money via QE, and rates are at zero. Can we all pause and revisit the makeup of the 7.5% CPI that we're all going ooh and ah about? This little bit of a chart here shown from Ottavio Costa, one of our favourites. He puts CPI numbers into perspective. Here are some price changes since January 2021. So that's 12 months ago. Natural gas up 81%. Oil up 66%. Agricultural commodities up 24%. Rent up 13%. Used car prices up 44%. Gasoline up 36%. Cattle prices up 20%. Lumber up 15%. Coffee up 92%. Hotel prices up 37%. Far out. 7.5% for CPI, hey? We've written many times and talked about the weightings and composition of the CPI basket. It's the same for Australia. They don't want Joe Public knowing the full number. Does your wallet really believe Australian inflation is only 3.5%? Remember when the world is carrying the debt burden it is today, when the issuer of the world's reserve currency has public debt equating to 30 trillion or 100% of the total GDP of that country, the only way to reduce that debt is through inflation or default. They need the former and can't afford the latter. So why scare the public with higher inflation figures when you can quietly rob them to pay down your excesses? As sure as night follows day, central banks will be forced into tightening what has been a historically unprecedented loose monetary experiment into an economy built largely off it, and hence unable to handle it. We discussed this last week, and it was an important article we wrote about it. You can also go back and check that out. Gold and silver have been inflation hedges and hard safe haven assets for 5,000 years. Whilst the scale of hubris and monetary abuse of this credit cycle may be unprecedented, the inevitable outcome is not. It's starting to feel like that the outcome is getting closer. This is history simply repeating without lessons learned, as humans, and in particular our political and corporate leaders, cannot resist the greed and self-interest that a credit-based fiat monetary system allows. The changing world order that Ray Dalio recently spoke to is a repeating cycle. And are you ready? A lot of our listeners and readers definitely are. So we are definitely preaching to the converted, but it's great to keep an eye on it nonetheless. Enjoy Friday, everyone, and have a great weekend. We'll catch you Monday for more news.